But let's now kickstart the show by talking about some primary market action because that space remains very hot. The 1,008 crore initial public offer of Happy Forgings has opened for subscription today. The price band for this issue is 808 to 850 rupees a piece. Just a little bit about the company. It is the fourth largest engineering-led manufacturing of forging products in the company. And to discuss more about this, we are joined by Ashish, Garg, the managing director, to take some questions on what their plans are once, they do come to the street and how growth could really pan out. Ashish, thanks a lot for joining us today and, welcome to the show. I'm Pavitra. So, just to kick things off, because this is the first time that we're speaking to you, take us through a little bit about the company. Who are your top 5 OEM clients? What is the kind of growth that you're penciling in? And then I'll come to the post-listing plans, what you plan with the fundraise, etc.
So we are in a forging and a machining business. We started with the bicycle pedal manufacturing, and since then we are the second largest manufacturer of diesel engine crankshafts in the country. So it's not a sector-specific business. So we are catering to sectors like commercial vehicle, farm equipment, off-highway, as well as industrials. Within industrials, we cater to wind power, oil and gas, as well as railways. Today, 85% of our revenue comes from machine components, with the highest in the industry. So we are no more a forging company. As per Ricardo, we are the fourth largest engineering-led manufacturer for safety critical components. And we have a cumulative capacity of 1,67,000 tons in forging and machining today.
Oh, absolutely. We have noticed that you have, diversified beyond just the forgings. But, I was looking at the growth for you. The compounded growth is over 40%. So that looks very good. Do you think this is something that you can sustain in the years to come as well, around 40%? Do you see it going even higher?
To be very honest, we are looking at a lower base of FY21 because of the COVID year. But if you talk about the growth in the last 5 years or 10 years scenario, the top line growth is in the range of 18 to 20% CAGR. In fact, the EBITDA growth is upwards of 24% in the last 10 years. If you talk about 10 years CAGR. So going ahead, we are looking at, a similar set of growth. And with the primary fundraising coming in the company, we'll look at accelerating this growth trajectory.
Got it. Just talking about diversification, I was looking at your RHP, and you've clubbed your revenues into CVs, 40% exposure. Farm equipment, about 33% of your revenues come from CVs. Off-highway vehicles is 12%. And the fourth one is industrials, which is the sale of products to manufacturers of industrial equipment, machinery for oil and gas power generation, railway and wind turbine industries. Now that number, this revenue contribution to industrials, has gone up significantly. In FY23, it was about 3.7%, and in the first half of this year, it's gone up to 13.7%. Can you talk a little bit about that, and what could that number go up to, and are the margins any different here?
So industrial is one category. So we invested on the 14,000 ton press line, which is the second largest line in the country, and we started manufacturing components up to 250 kg on this line. So prior to that, we were forging components up to 90 kg, and this 250 kg line of products was set up last year. It took us almost 2.5 to 3 years to just install and commission these lines. And with this installation, and we today we have almost 24 clients in pipeline in industrial space. Industrial is one business which is growing for us, especially the wind sector, as well as the heavy industrial engines. And going forward, this year you mentioned the business has picked up from 3.7 to 14%. Going forward, we feel that it will be around 20-25% of our revenues going forward in next 18 to 20 months.
Okay, so in the next 1.5 to 2 years, the contribution of industrials will go up from 3.7% in FY23 to 20 to 25%. One more aspect, even on exports, your exports were about 9 to 12% over FY21 to FY23. In the first half of the year, it's increased to 20% plus, 20.75%. What led to this sudden big spurt in your export volumes, and what can you guide there?
So even on the export side, today the direct exports is around 21% in H1. Indirect exports is also around 11%. So exports have risen from 50 crores in FY21 to almost 300 crores in this financial year, which is almost 6x. And going forward, the 60% of the incremental business which is in pipeline is coming from exports. So going forward, we expect exports to be range bound 25 to 30% in next 12 to 15 months for us.
Okay, around 25 to 30%. Another portion I want to talk about is the margin picture, because I am seeing that your margins have been quite strong. It's in the range of 27 to 29. It's also significantly higher than a lot of your peers. So A, what are you doing differently? And is there scope to increase the margins even from these levels? Or do you think it's going to stay around this 27 to 29 kind of band?
Yes. As mentioned earlier, 85% of our revenue comes from complete machined component business, which is one of the highest amongst the listed peers. So our contribution because it's forged in-house and then it's also machined in-house in a very, in 10 to 12 micron category, and it's very specific and very safety critical components where the contributions are very high. So going forward, as steel prices are falling slightly and because of the export mix and heavy industrial range of business, we see margins to be range bound between 28 to 30% for us.
Got it. What about your contribution from your top 10 clients? It's quite high. It was higher before. I think 2 years back, your revenue contribution from your top 10 clients was 80%. Last year, you brought it down to 70%. But it's still on the higher side. Do you have plans to reduce concentration risk, client concentration risk?
Yes. So today we have over 66 clients. And 30 clients we have onboarded in the last 5 years. So this client concentration will definitely go down. So it has gone down to 67% in H1. We'll probably close at around 65% in this financial year. Next year, probably we are looking at around 55 to 60%. Because these new customers that we have in pipeline, we are ramping up with them. So going forward, the incremental business is coming from these new clients, and definitely this concentration will definitely go down. But considering, many auto component players, we have not grown with one godfather, so it's fairly diversified even today for us.
Okay, got that. We were also looking at your post-listing plans. You do want to use a large chunk of the proceeds to prepay your borrowings. Can you take us to what the debt is right now, the full debt, and how much will it come down to after the fundraise, after the IPO?
Today we operate at the lowest debt equity in the market, which is around 0.22. And payables today for us is around 20 days. So literally we buy everything on cash in terms of steel. And going forward, around 150 to 170 crores is planned for the repayment of debt. And with the primary fundraising coming in the company and with the strong cash accruals that we have, so we'll probably be a debt-free company as we're looking at.
Debt-free by end of this year with the money that you will be used to prepay the debt?
Yes.
Okay.
Yes.
Got it. Some part of your money is also going to go towards purchase of plant and machinery, 172 crore. Can you tell us a little bit more about your capex plans over the next 3 years? Because you already told us that how you did some plant expansion, which helped you tap into the industrial market space in a big way. What more is lined up on the capex front over the next 3 years?
So we have deployed over 600 crores. We have almost doubled our gross block in the last 4 years, from 600 crores to almost 1200 crores. And we see the similar, trajectory going forward as well. So 70% of the cash accruals are deployed every year in the business. And going forward, we see that we'll be maintaining this. And with the primary fundraising coming in the company, we are looking at 900 to 1,000 crores of capex in the next 3 years.
All right, Ashish, we're going to leave it on that note. Thanks a lot for speaking to us today. All the best with this issue, and we do hope to have you back on once the company is listed, and then we can talk a little bit more about the numbers. That is the management of Happy Forgings talking to us about their plans. They're telling us that currently their revenue CAGR in the past 5 to 10 years has been around 18 to 20%. They do have a pretty high concentration in terms of the top 10 clients, but they are looking to bring that down to around 60% as well. So that is the management. With that, we're going to get into a short break. On the other side,